Hi, good morning, everyone. Thanks for joining us for our weekly morning call. We have quite a few stock updates as well as a few Phillip on the grounds. We also have our macro sector outlook, the FAANGM Monthly, the Singapore Banking Monthly, as well as our usual Singapore Weekly. So without further ado, I'll hand it over to Jonathan to talk about the FAANGM Monthly.
Thanks, Glenn, and good morning, everyone. So I'll be presenting the FAANGM Monthly for July. Next slide, please. So July was actually the strongest month for the FAANGMs for this year. They were up about 13.4%, modestly better than Nasdaq, which was up 12.6%. S&P 500 also gained 9.1% for the month. But overall, year to date, the FAANGM remained 20%, roughly about 20% down, while the S&P is down about 13%. In terms of the FAANGMs, Meta and Google were the laggards, down 2% and up 5.7% respectively. These stocks were mainly hurt by the pullback in economic-sensitive advertising spend. Amazon and Netflix were the best performers, jumping 27.2% and 28.7% respectively. This was largely due to better than expected revenue and subscription numbers. Next slide, please. So for Meta, they actually are going to be increasing the prices of their VR headsets, Quest 2. So they're going to be increasing these headsets by $100 from $399 to $499 for their 256 GB models. And the company stated that these price increases were a result of increasing production and shipping costs. So there's also a new FTC suit that's aiming to block the company's acquisition of Within, which is a creator of VR fitness app Supernatural. So this deal is worth about $400 million. And the FTC is claiming that this deal significantly lessens competition and is accusing Meta of buying its way into more market share. One of the main reasons for this is that Meta already has its own VR fitness app called Oculus Move. In terms of their results, second quarter results were a mixed bag with revenue in line with expectations, while earnings missed slightly. The increasing popularity of Reels continues to drive positive user growth, while ad impressions were also increasing 15% year-on-year. Guidance for the third quarter was quite soft, citing continued weakness in advertising and FX headwinds. For Netflix, Netflix actually picked Microsoft as their global ad sales and tech partner. So they're going to be working together to build a new ad-supported subscription tier for Netflix users, which has been stated throughout the first 2 quarters of this year in their earnings call. So Netflix actually cited a couple of reasons for this. The first would be Microsoft's aggressive go-to-market capabilities. And the second, and more importantly, would be Microsoft's strong privacy protocols. In terms of streaming, streaming continues to gain market share in US TV usage. So as of June 2022, streaming as a share of total TV usage increased by about 1.8% month-on-month to 33.7%. So it's taking shares from all other traditional segments like cable and broadcast TV. So of this 33.7%, Netflix leads all platforms at 7.7%, which is up about 0.9% month-on-month. So Netflix's second quarter earnings were in line with our expectations, with first half of 2022 earnings at 55% of our full year forecast. This is mainly due to an unrealized gain of their euro-denominated debt remeasurement. So Netflix also had lower than expected subscriber loss, so they lost only about 1 million subscribers compared to an expected 2 million losses. And it guided to a turnaround in subscriber losses for the third quarter. So they actually guided to 1 million subscriber additions instead. Netflix also guided to $1 billion in free cash flow for FY22, mentioning increasing profitability and stabilization in content spend as the main reasons for this. So moving on to Alphabet. So Alphabet is actually they actually settled a Play Store antitrust case with US $90 million fund. So Alphabet actually agreed to set up this fund to support American developers who earn $2 million or less in annual revenue from the Play Store from 2016 to 2021. Along with this fund, Alphabet has also launched a new program for developers, allowing them to pay a reduced service fee of 15%, down from 30% on their first $1 million in annual revenue. So they also are expanding app billing options in the Eurozone. They're going to be allowing non-gaming apps in the EU to offer alternative billing solutions outside of the Play Store. This comes as it is trying to relax some of its billing policies in the face of scrutiny from regulators. So it seems that Alphabet is starting to cave into pressure from regulators regarding its Play Store monopoly. It's been slowly adjusting its business model and allowing increasing amounts of alternative payment methods, as well as reducing its commissions. In terms of their second quarter revenue or second quarter results, revenue was in line with expectations, while earnings missed quite significantly. This was mainly due to a one-off unrealized loss in equity and debt investments. Also, a pullback in ad spending across all verticals and industries continue to reflect weaker macro outlook, which we expect to continue moving into the third quarter of this year. Next slide, please. So for Apple, Apple is actually facing another class action complaint proposed by Affinity Credit Union that's targeting the Apple Pay. So the complaint mainly circle around fees that Apple charges to credit card and debit card users or issuers, which are absent in Google Play and Samsung Pay. Google Pay and Samsung Pay. So the union actually claims that these fees would not have been sustainable if Apple actually faced competition in the payments service. Secondly, they're actually scaling back on hiring and spending. So Apple is actually giving selected teams a lower than expected hiring budget. And the company will also not be increasing headcount in some groups in FY23. So despite this, Apple is still planning an aggressive product launch scheduled to release in the first quarter of FY23. In terms of earnings, they announced the revenue beat for its third quarter 22 earnings call, with iPhone and services achieving record sales for the quarter. Mac and iPad saw negative revenue growth. And one of the reasons or rather some of the positives is that iPhone active install base actually reached a new all-time high, driven by strong growth in the number of switchers. So more and more people are switching from, Android to iPhones. As well as sustained customer loyalty by its existing customer base. So the decline in Mac and iPad was mainly attributed to supply constraints as well as an unfavorable FX. So Apple actually expects revenue growth for the fourth quarter to accelerate, even with continued FX headwinds and some reduced supply chain constraints. In terms of moving on to Amazon, so Amazon actually had their Prime Day in the third quarter of this year, compared to the second quarter of last year. It was actually their biggest Prime Day in history. So there was more than 300 million items sold, and which is up about 250 million from last year, or rather up 50 million from last year's 250 million. So this performance kind of came as a pleasant surprise given the high inflationary environment and the weakening kind of consumer demand that was expected to kind of have a negative effect on Amazon Prime Day. So Amazon is also going to be deploying their Rivian EV delivery vans. The company said they will use EVs to make deliveries in cities like Chicago, Dallas, Phoenix, San Diego, Seattle, and St. Louis. This is quite interesting because it marks a significant step in Amazon's push to achieve a net zero carbon emission by 2040. Amazon also acquired One Life Healthcare, which is One Medical's parent company, in an all-cash deal of roughly $3.9 billion. The acquisition, which followed the purchase of online pharmacy PillBack, is part of the company's effort to deepen its presence in the healthcare sector. Amazon announced mixed performance in its second quarter results call. Revenue beat top-end guidance as a result of positive operating income. However, the company recorded a net loss for the quarter, and this was mainly due to a change in equity valuations of Rivian. So moving on to our last counter, Microsoft. So there's actually a UK regulatory body that's opened an investigation into Microsoft's acquisition of Activision Blizzard. While they are scrutinizing the deal to see if it will harm rivals. So the regulatory agency will decide, when whether it's prudent or whether it is necessary to conduct a full in-depth inquiry by the 1st of September this year. So Microsoft said that it's still optimistic that the transaction will be completed in 2023 as planned. In terms of their results, their fourth quarter results, slightly missed expectations but the demand for Azure cloud remains strong. In terms of guidance for the first quarter of 2023 or FY23, the company guided Azure to grow about 43% in constant currency basis. And we do remain positive on the continued strong demand for Office 365 offerings, especially as offices reopen, and migration to the cloud should contribute to revenue growth moving forward as well. Next slide, please. So we remain overweight on the FAANGM. So revenues beat for the most part across most companies in the June quarter, with demand slightly better than expected. Earnings did miss across the board. This was mainly due to FX headwinds, losses in equity investments, and contracting margins. Our preferred picks still remain Google and Microsoft due to high levels of corporate demand for cloud and productivity solutions. One major change that we made in terms of our ratings is that we downgraded Amazon from a buy to a neutral. However, we did keep the target price the same. So one of the reasons why we downgraded is because there was a huge run-up in the stock price after earnings came out. So that's all for the FAANGM for July. I'll pass my time now on to Glenn for Banking Month. Thank you.
Thanks, John. So for Banking Monthly, firstly, we'll just do a brief overview of the three banks' results. So for the three banks, all their PATMI actually were in line with our estimates, and this is mainly due to the bank's net interest income rising 17% year-on-year, as NIM, net interest margin, improved by 8% year-on-year, with loans growth of 8% year-on-year. And the NIM improvement was mainly due to the rising interest rates, as the impact of the interest rates hikes were more fully felt. So the banks have actually raised their full year 22 NIM guidance, and this is ranging from 1.7 to 1.73% for the full year 22 NIM. Loans growth guidance, however, has been lowered, and this is from mid to high single digit previously to mid single digit. The net fees and commissions were a drag, and it declined 10% year-on-year, and this is across the board for all three banks. This is mainly due to lower wealth management, brokerage, and investment banking fees, and it is in line with the weaker investor sentiment globally. Credit costs, however, has continued to moderate across the board, and the full year 22 provision guidance for the banks have been maintained. DBS is stable at 11 basis points, and OCBC and UOB at 20 to 25 basis points. The CET1 ratio also has been quite stable at 13.1 to 14.9% for the banks, and this is above the operating range for the banks at 12.5 to 13.5%. So now moving on to the interest rates. The interest rates have reached new highs in July, and they have continued to increase. The 3-month SOR was up 64 basis points month-on-month to 2.47%, while the 3-month SIBOR was up 51 basis points month-on-month to 2.02%. And this is the highest the interest rates have been for the past 7 years. The 3-month SOR is 103 basis points higher than the second quarter 22 average of 1.44%, and is improved by 228 basis points year-on-year. While the 3-month SIBOR is 80 basis points higher than its second quarter average of 1.22%, and is improved by 159 basis points year-on-year. For Hong Kong and Malaysia loans growth, for Hong Kong, the domestic loans growth declined 2.34% year-on-year and 0.17% month-on-month in June. The year-on-year decline in loans growth for June was the first decline since January 2022, and the month-on-month loans growth decline of 0.17% was down 63 basis points from May's positive loans growth of 0.46%. For Malaysia, their domestic loans growth was positive at 5.61% year-on-year and 0.68% month-on-month in June. The increase year-on-year in June was the highest since March 2019, and an increase of 62 basis points from May's loans growth of 4.99%, while the increase month-on-month was an increase of 40 basis points from May's loan growth of 0.28%. The preliminary SDAV for July, it dipped 25% year-on-year to 886 million, as market sentiment remains subdued due to the macroeconomic factors, while the VIX averaged 25 in July, and this is down from 28.3 in the previous month. The top 5 equity index futures turnover also saw a dip of 9.4% year-on-year in July to about 13.74 million contracts. And this was mainly due to lower trading volumes of its FTSE China A50 index futures and the MSCI Singapore index futures. Notably, the Nikkei 225 index futures, it decreased 36.8% month-on-month to 1.11 million, and the FTSE China A50 decreased 17% month-on-month to 7.83 million. So we maintain overweight on the banking sector and remain positive on the banks. The bank dividend yields are attractive with upside surprises due to excess capital ratios. The rising interest rates remain tailwinds for the banking sector. SGX is also another beneficiary of higher interest rates, and we'll see with their results coming out this week. Now I'll move on to CapitaLand Investment and their recent first half 22 results. So a brief overview of their results. Their first half revenue of 1.354 billion was in line, and it forms 50% of our forecast. The RE investment revenue grew 44% year-on-year and was driven by a broad-based recovery, while fee-related revenue was up 9% year-on-year, lifted by their PE fund management and lodging management revenue. For the positives, the fund management fee-related revenue was up 21% year-on-year, and it formed 16% of revenue. PE fees up 81% year-on-year were boosted by higher transaction-related fees, which formed 51% of PE fees, while recurring PE fees remained stable and grew 2% year-on-year. The first half PE fees included performance fees of 31 million Singapore dollars from notable transactions, such as the unwinding of CLI managed CapitaLand Vietnam commercial value-added fund on January of this year, as well as the reduction in equity stake in Athena LP on February of this year as well. For the second positive is that the lodging management fees rose 37% on recovering operating performance, as well as 8.2k new units turning operational in FY21 and 4.5k new units turning operational in the first half of this year. The RevPAR grew 44% as average daily rates grew 21% and portfolio occupancy increased 9%. Recovery was seen also across all of CLI's key markets except in China, with the strongest RevPAR recovery in Europe and in Singapore. The group also signed 4.5k keys in first half, and this is about 54.9% of the number of keys signed in FY21. The third positive is that the real estate investment business grew 44% year-on-year, and this is on the back of reopening in most of CLI's markets, except for China and Japan. The significant easing of community safe management measures since March of this year has improved business and consumer sentiment and increased activities. The leasing activity in India has similarly picked up, with physical occupancy at business parks improving to about 35%, and this was from less than 5% in 2021. However, due to China's zero COVID-19 policy, Shanghai was placed under lockdown since March of this year due to the spike in COVID cases, and this has stalled leasing activity, which has resulted in rental rebates given to the affected tenants in the second quarter. For context, 15 of CLI's assets are in China, representing about 34% of its China exposure. For the negatives, there's one negative, is that the macroeconomic and geopolitical headwinds are slowing fund generation and acquisition momentum. So inflation, rising interest rates, and the Russia-Ukraine conflict have resulted in more circumspect behavior and higher required returns for capital investors. And this is limiting the assets eligible to seed funds. While the USD denominated capital has taken a wait-and-see approach towards the renminbi investments, CLI's renminbi fund management license allows it to tap local capital. However, lockdowns and tightened restrictions in China have impeded business discussions and may delay planned transactions if lockdowns persist. For the outlook, CLI's real estate and lodging management business should continue to recover on the back of further easing of travel and mobility restrictions. Currently having divested 1.6 billion Singapore dollars year to date, CLI is on track to hit its annual divestment target of 3 billion. However, its 10% FUM growth target may be at risk given the current macroeconomic and geopolitical headwinds, which have resulted in more circumspect behavior among capital investors. Prolonged lockdowns in Shanghai and Beijing may also delay planned transactions. As such, we maintain our accumulate recommendation with an unchanged target price of $4.12. The pickup in travel and lifting of lockdowns in China will be immediate catalysts for CLI. So that's all I have for CLI. I'll now hand it over to Terence.
Thanks, Glenn. For Pan United, the construction recovery hit a snag in the first half 22 as stop work orders by the Singapore authorities impacted their NOPAT. So in terms of the first half 22 summary, revenue and NOPAT was both up by 22% and 83% year-on-year respectively. If you look at the table here on your left-hand side, you can see that the 22.2% year-on-year increase in revenue was driven by both higher selling prices and demand for ready-mix concrete. First half 22 revenue was in line, but the profit was below at 34% of our full year 22 estimates. The revenue growth was driven by higher demand and ASP, which rose 5% and 18% year-on-year respectively. The group also saw better GPM, gross profit margins during the period as they successfully passed on rising costs of RMC to their customers. Its NOPAT also got a lift from higher contributions from its associates of $3.6 million. This uplift in contribution was from the sale of coal from their associate PT Lana Harita Indonesia. For perspective, coal prices in the first half of 2022 rose 182% year to date. One negative during the period was the workplace fatalities and the dengue, which hampered the overall construction recovery. In the first half of 2022, they had 28 workplace fatalities. There was also 12,000 cases of dengue for the first half. This compares with the 5,258 cases for the whole of 2021, resulting in a number of stop work orders and a slowdown in the movement of their concrete. The slowdown differs from site to site, but on average, the overall volume declined by about 15%. In terms of outlook, in our next slide, the construction recovery continues to see a faster pace of recovery in the first half of 2022. As you can see from the table on your left-hand side, the tailwinds continue to remain intact for the full year 2022. HDB continues to guide for 23,000 flats to be launched for this year versus 17,000 in 2021. On the back of this, we maintain our buy rating, but with a slightly lower target price of 54 cents. We trim our FY22 and 23 earnings by 26% and 11% respectively on account of the higher staff, utilities, and materials costs. Our target price is still based on 12 times FY22 earnings with a 20% discount to its 10-year historical earnings on account of the still uncertain business environment. So that's all from me for Pan United. Our next counter is on Genting Singapore which is Phillip on the ground. So Genting Singapore reported their first half 22 results. We saw a 20% rise in revenue, but NOPAT declined 4%. The 20% rise in revenue was lifted by their gaming and non-gaming segment. Gaming segment saw a 7% increase on a year-on-year basis. The uplift came from borders relaxation. However, the travel recovery from Jakarta and China will move the needle. They also recently received renewal of their casino license for RWS for another 3 years. Non-gaming segment grew at a faster pace, driven by an improvement in RevPAR. The NOPAT drag, however, came from the challenge in hiring of workers. This is the current biggest challenge faced by Genting Singapore. They are looking to hire an additional 1,500 workers across all their business divisions, which includes sales and marketing, their MICE, attractions, hotels, and F&B. The competition from MBS is also strong. The MBS is also looking to ramp up hiring, seeking to fill 1,750 workers to cope with the upswing in tourism and revenue. MBS has gained market share during the period, though Genting didn't reveal how much. In terms of shareholder capital return, Genting declared an interim dividend of 1 cent to reflect the better outlook in 2022. This compares favorably with no dividends declared in the prior period. It has no plans to do share buyback, but will explore opportunities to utilize its cash balance. In terms of outlook, the management guided that they see higher utilities costs eating into their margins by about 1 to 2%. Higher staff costs also a potential worry, but they didn't quantify how much of this will negatively impact their EBITDA. The current ramp in hiring also does not account for the potential return of Chinese travelers and only takes into account their outlook in the next 12 to 18 months. So that's all from me for Genting Singapore. I'll now hand over the time to Paul.
Thanks, Terence. I'll move on to HRnet's results, faster growth outside Singapore. Next slide. So the results were in line. The first half revenue and PATMI was about 50% of our forecast. The first half profit actually was up 12%. There were a few things to strip out because the headline numbers was basically down 4%. There was excluding the fair value losses and also some one-off reversal of accruals. In the highlight for us in terms of the results was that the rest of Asia has grown faster than Singapore. And now these regions, which is namely China, Taiwan, Indonesia, these are roughly 40% of revenue compared to maybe less than 30% a few years ago. So how they've been building the presence outside, which is important for us because so that their growth is not just confined to Singapore, is that they will increase the number of co-owners. So co-owners is an important part of the model. So when you have a co-owner, they can drive the business because it's a very localized business. And of course, higher, more headcount, and they move into flexible staffing. So as a refresh, this business, there are two parts, which is the permanent hiring, your typical headhunting business, and there's the flexible hiring, where it's a bit more capital intensive because you typically pay for the salary of the workers before the employer pays you. So let's say you're a hospital wants 10 workers, then you typically pay for the 10 workers salary before you. So what they've done, how they grown the business outside is also they started to introduce flexible staffing into the rest of the region. The cash flow continues to be strong. They generate 33 million. They also announced, as you can see from the table on the left, maiden interim dividends of 3 cents. So if you add this 3 cents dividend, you add the share buyback of 30 million and all the dividends they paid out for this year, this calendar year. Of course, these are mainly dividends for last year. They technically paid out almost 100 million of cash to shareholders this year. The negative is still the volatility because in what they've done is, I think they have like probably 20-30 million or around there in terms of assets. So they do invest in listed recruitment companies, purely passive investments, and this will cause a lot of volatility in the earnings. In terms of the outlook, I think the weaker economic conditions in the region may have some impact on the volumes, but I think the positive side is, like for instance in Singapore, there's still very high job vacancy rates, and the reopening borders will also drive the revenue growth. So although the economic condition may be weakened, but there's still a lot of vacancies and people are still scrambling to look for headcount. The sustainability of North Asia, namely China, can improve with the lockdown ease. So a surprise was that even though China was locked down, they still managed to grow their North Asian business by 28%. So what they did was that one of the strengths is to try to veer into the faster growing segment. So although China, most parts were slow, but they managed to get a lot of business from placing up semiconductor headcount. to local and multinational companies. So that's a very important strategy for a headhunting company where not every economic sector will underperform. So you got to pick up your spots. Likewise, just to give you an example separately, in Singapore, when the pandemic happened, so you needed a lot of temp workers for vaccination and so forth. So they managed to capture that opportunity, although the economy was technically in recession. So we maintain our buy, no change on our forecast. So for flexible staffing, which is the temp workers, it will grow by new geographies. For instance, like Indonesia, they're introducing this, and of course, reopening. So although they lost the vaccination, a lot of the temp workers last 1-2 years has been the vaccination centers. Now this has been picked up by more in the malls, marketing personnel, and also hospitals that are non-vaccinated related, also in high demand. Permanent hiring will be just the usual unfilled job vacancies, and they also increased their number of full-time consultants by I think 4 or 5%. Next slide. So for PropNex, revenue diversity was a strength. So next slide. So what we're referring to is that if you look at the table on the left, project marketing, which is basically commissions from selling of new launches, new homes. So that declined sharply, but the rest did well. Was more resilient. So the results was more or less in line. Although you can see that it's on paper it's still higher than our forecast, but we think second half will be weaker, especially from the lack of project revenue, which is the project marketing revenue. So in terms of the positive was resilient revenue. They managed to grow. Even the rental was up 23%, and HDB was still grew by 5%. The negative was in our estimate, there was basically no new launch for them, not enough launches for them to sell in the first half. So there was an estimated 1,005 new residential launches we estimated. But last year, that means first half of last year was almost 5,000. So you can see there's like a 70% drop. So this was definitely going to impact their commission from new homes sales. There should be some recovery next year. Second half, you will jump back to about 5,000. Depending, because some might be delayed and so forth. So in terms of the outlook, the property price will remain elevated. There's like a virtuous cycle right now in the property market, where some of the HDB upgraders, when they sell their units, in general, they can get equity for almost like 300,000 and then use it to upgrade to new homes. Then of course, the next question is like, who's buying all this HDB? Then will be like the PRs and also those who actually sold private property units and now they want to cash out and then move to HDB. So there's this kind of virtuous cycle going on right now. Of course, the other tailwinds is rising income levels, low supply and so forth. We still maintain that they're neutral because what we think is that although you see the weakness in new launches in the first half, like we mentioned earlier, down 70, but the real impact to revenue will only come in the second half because there's like a 3 to 6 months lag from you sell to you collect the commissions. So what we worry about most as we enter into the second half is some possible cooling measures. But these are a bit more like not stamp duty, but one likely cooling measure could be the TDSR. So for TDSR, when you apply a housing loan, the banks will typically stress test the loan with interest rates of 3.5. Right now, interest rates are almost like 3% for mortgages. So I don't think the stress test 3.5 is of value right now. So there's a high possibility that the authorities might raise the stress test to 4.5. And this could impact a little bit on those who are eligible to buy property. Likewise, because HDB prices have climbed double-digit levels over 12 months, there's also a risk that the HDB might also intervene. In the past, when they could just one lever that they could intervene to cool the HDB market was just to increase BTO, but because of all the construction delays, they don't have that level. So, not sure what they're going to do, but there's also that risk that they might cool the HDB market. Next slide. Okay, these are just comments that we got from PropNex. They give a very good overview of the market. I'll just very quickly run through some points, not to delay this too long, but in terms of the impact on interest rates, so some rough number, 1 percentage points will raise installment by $500. Demand was still very healthy. The famous AMO launch in Ang Mo Kio, they collected a few thousand checks, although I think about 1,000, sorry, not few thousand, maybe about 1,000 plus checks compared to the actual launch was only 300. So this is just a reflection of the demand was very strong. The market share can be affected a little bit because these days it's not about how many customers you get, but it's almost like how lucky you are, because most of the new launches have to go about balloting, which is, I guess, kind of show a bit overheated. So they are moving overseas, but this is still small. There was some bad debt provision, so dragging down their earnings was a 1 million impairment. But again, this is mainly because developers delay, because of construction delay, nothing to do with it turning really bad. I mean, developers all sold out, so obviously they're going to perform well, they're going to pay the commissions. I think the next bullet point, number 5, is just to show that most of the growth has been in the outside the central region, which is the mass market. So over the last 12 months, there was a 21% jump to 2,000 square feet. I guess AMO was the, and this was even before AMO. So this is up to June that the prices jumped, which is a bit too strong, I guess. So basically in the first half, the OCR prices jumped 18% over 6 months, but the CCR was actually down. So CCR is, I guess, where the value is, if there's such a term, but it was the weakness, where the weakness is. Inventory remains low, especially in the mass market, only less than 1 year of sale. The highest inventory is in the core central region, which is, they still think that the decline, they raised their guidance, their estimates of the number of the decline in new home sales from 20-30% to 30-40%. So basically, this is going to impact their revenue for this year. And of course, resale will still decline, and then PropNex will decline, HDB resale decline. So all this is volume numbers. Next slide. Thai beverage, the recovery. So next slide. So for Thai beverage, again, this is just an update. So for third quarter, there's very limited financials. They just give like a 1-pager or less. Although many pages, but the real number is only 1 page of give you a bit of revenue and EBITDA. So and there's no briefing, so we got very limited information. But anyway, the results were generally in line with our forecast. The positive was that the beer business rebounded very strongly. So if you look on the table on the left, the beer is up 43%. But do note that this is from lockdowns. I was thinking last year, Vietnam was virtually shut down. So when you cannot sell to now, you can sell. Obviously, you're going to get a big jump in revenue. But the more positive thing is that they increase price, better mix, and so forth. So all this help. And also their margins, we calculated, is probably one of the highest on record for the beer business. The negative was on the flip side was the spirits, which accounts for almost 80-90% of the profits. So this one, the volume was down, and I think it's mainly because of just the weak economic conditions for them. It's one of the weakest volumes that we've seen. The other reason why the volume is the sales were down because they have quite a big large business in Myanmar for spirits, which is basically like whiskey. And then they got because for them there are 2 types of spirits. There's the white, which is normally consumed at home and so forth, and the brown, which is consumed in pubs and clubs and so forth. So that was affected because of the lockdown. But in terms of the outlook, I think the outlook is going to be favorable because they are recovering from the lockdowns. I think there's a typo here, the weaker economic conditions. Actually, the stronger economic conditions should improve. More important for us is that because they raise prices for beer, for spirits, and so this will stick. I mean, they're not going to cut price. And then with the commodity prices starting to roll over, you should see gross margins continue to improve. So this will be I guess for me, the biggest positive. But they might the only thing is that because one of the strengths during the downturn was they really cut operating expenses like marketing. So that might climb back up a bit. But overall, we upgrade to a buy. We didn't change our target price or forecast. It was mainly because of the share price weakness. And another positive is that the opening of the entertainment values in Thailand from 1st June would also support their earnings, especially their beer and also the brown spirits. Of course, separately, the company announced that their Beer Co spin-off is going to be deferred due to challenging market conditions. I know basically you cannot get the market valuations that you can't get the PE that you wanted, so you just cancel it. The next slide. Next slide. Okay, in terms of technical views, there wasn't any major macro news coming up, but we got some neat numbers on some of the land transport data. So SBS, the rail traffic was still very strong. So the rail is up 51% year on year. It was up 80%, almost 80% last year. Taxi numbers continue to decline, but when we look at the LTA numbers, is quite ad hoc numbers. Once in a while it comes, there's no schedule for it. But we saw that the May, June, the street and ride hail app trips was up 20% for the last 2 months. So there's a positive for the taxi business, I guess. The US, I think we know the CPI, core CPI, I won't run through that. But more important was also some of the Fed commentary. So for this one is the more important of Charles Evans because he's on the FOMC board. So he still says that inflation is still unacceptably high, which is of course because inflation is still 8%, although it's down month on month, it's flat month on month. So they're still going to raise rates, and the likely that rates will not drop and will still climb up in 2024. Another comment by another Fed official is almost the same thing. So you should still expect interest rates to climb. I think there's no change from that, and it's just one data point doesn't mean that the Fed will cut rates and so forth. But nevertheless, I think that our tactical views is that we still think this so-called inflation peak rally can continue, because we think that CPI will continue to soften the inflation numbers because of the weak commodity prices. And ironically, if we get more and more soft economic data, it will just reinforce the need for the Fed to pivot. I mean, that's what the market thinks. So I think, but of course, the risk of this rally is that it's going to be dependent on commodity price. If there's any sudden surge in commodity price, then this whole rally might come off. But I think later on, after this Fed pivot rally comes about, I think the worries will come with, I think we guess is that the recession worries will return because the economy is still slowing down quite sharply and the yield curve is inverted. So it also suggests that we are on the cusp of a recession. So I just think that we get this rally, but then the market might just turn negative as the economic conditions slow down faster than feared. But nevertheless, we think interest rates are on the cuts to rise by 100 basis points this year, the next few months. Yeah. In terms of key events, there isn't really any major key events. But for our webinars, we have tomorrow marathon from the US and also first read. So do sign up if you have the time. Next slide. So this is inflation. This is just as a reference. But the one is on the right-hand side. So this is the table of the US CPI. So we wanted to, since CPI is such a key barometer now of where the market direction is, so wanted to have a look at the components. So you can see that the market was rejoicing because month on month in July, you can see the 0.0. So the market is believed that there's a peak in inflation because month on month it was flat, and there's justification for this. Because if you look at this, most of the reasons why inflation kind of flattened out month on month or declined month on month was because of energy prices. So commodities is going to pull down the CPI, and this won't only just happen for 1 month. It's not that after this month then commodity will bounce back up. So this will probably drag the CPI down between month on month for the next couple of months. Of course, it's unclear the amount, but at least directionally, we think CPI might probably peak and it will continue to decline month on month, and this will give flicks to the rally, this short-term rally to the market. Next slide. Okay, I know it's already 12, but let me just quickly run through the three Phillip on the ground that we have. So we had Yangzhejiang Shipbuilding. So the earnings was strong, it was up 32%. The order book is also really strong. They got orders up to 2025. So if you order a ship now, their yachts are all filled. You only can get a slot in 2025, and it's probably going to be filled up by the end of this year. Most of the orders are coming from containers. Out of the 134 vessels on the order book, 100 is actually containers. Dry bulk not much orders from dry bulk because the earnings so good and they are not really ordering. So if there is a shipping ordering cycle again, it will really depend on dry bulks. The key one for them is LNG. So for LNG, this is the biggest boom now because, as you know, the Europeans are desperate for LNG because they cannot import Russian gas. Or I mean, they're trying to wean off Russian gas. They have to take on a lot of LNG. So demand for LNG is very strong. But the problem is most of these orders are going to the Korean yachts. So the Korean yachts have the better technology and they got a track record. They have done some. There are, I think, only 2 shipyards in China, according to them, including them, that can do LNG. Cost is actually coming off. So the steel plates are coming down and so forth. So in terms of the outlook, I think the earnings second half should be very strong again, because I think the margins should improve because the steel costs coming down, number one. And number two, most of the orders they took that they are executing now in revenue were the older orders. So those, the margins were slower because the ship ordering cycle only started. So the next few orders they fulfill, the margins will be much better because at that time the market was getting hot and then they could actually demand higher prices. But this stock doesn't move on results, it's going to move on the order book. So for us, the key right now is the container cycle is probably more or less over. So most important news is whether they can secure LNG, because if they can secure more LNG, it will mean that this will be another ordering cycle for them, because LNG is in demand, but just that they don't have enough of a track record. So key is to secure more LNG orders, and of course, maybe later on, if the dry bulk shipping cycle kind of bounce back up and there's a big ordering cycle, then maybe that could also kind of lengthen their order book, the 8 billion to a few more years. But for us, I think the key catalyst will be them getting more LNG orders. Next slide. Yang Chichang Financial, the profit was down 31, but I think their book value is 1, so they're trading at price to book of 0.4. Most of their earnings, if you look at the table at the bottom, is interest income, as you can see, the 185. So most of it actually comes from interest income. Because what they do is, for those who are not very familiar, they do debt investments, which in reality is called entrusted loans. So in China, when you want to one corporate lend money to another corporate, you do this thing called entrusted loans, and then the bank will be the middleman, will just kind of endorse it and register the loan. Most of this is only due for, it's only 1 year loan, and also they get a very good return of 12%. But the problem, if you go down to the outlook statement, we think that earnings will continue to decline. At least for the next 2 years, we expect earnings to drop. Because what they're trying to do is they're trying to cut this loan book they have from 4 billion roughly by 2 billion. So you can imagine they want to cut because they want to take the 2 billion and bring it to Singapore to invest in private equity. Like you can see from the 4th bullet point, maritime fund, invest in some equity. But in the meantime, 12% is a very good return. So you can just do some bank envelope. You decline 2 billion, 10%, you're almost like 200 million revenue shortfall interest income, because they are in the midst of transferring all this income. So earnings are going to decline, we think, at least for the next 2 years. And the share price is, although 0.4 is attractive, but that's probably the same valuations the Chinese banks are trading. The yield is also 6%, but can be volatile, but also again something similar to what the Chinese banks are also trading. So the question is, do you buy this or want to buy Chinese banks? I think probably the banks might be better, but again, it depends on everyone's choice. Next slide. This is my last one. So we had Sonic Aerospace. They did a Poems webinar for us. I guess for us, the interesting thing is just that they're trading below cash. The market cap is 55 million. Their cash is about 67 or 94 cents. So the profit was up 25%. You can see the table on the right. Just to I'm sure not many people will know what they do. So they are like a logistic freight forwarder. 2 parts of the business. One part will be B2C. That means, for instance, a US customer want semicon to be delivered from China to their plant in the US. So what they'll do is they'll just call the China office, and the China operations will just arrange everything. The truck to take, the trucking, the warehousing, the shipping, and everything. And also the custom clearance. The other part is B2B, where they will just buy one big cargo space from a ship and then just resell it to other freight forwarding. They carry everything. You can, like, semiconductor, perishables, even durian, sometimes auto parts, mask, PPE, fashion. Basically, they're very dependent on global trade. The cash is high, but they just warn also that they need the cash because they still have like AR 30 days, but the accounts payable is only 14. The competitors are there, Kuhn and Nagel Schenker. In terms of the outlook, they think seasonally second half tends to be stronger, so that should continue. I mean, unless there's some major deterioration in global trade. And they're trading like 5 times PE. Okay, then thanks. I think we can move on. I think to Q&A.
Thanks, Paul. I think I'll just take one of the questions first. One of them asked, for CLI, what does event-driven fees mean? So event-driven is basically they are intending to profit from investing in securities that are subject to corporate events. So what would these corporate events do is that they can cause the inefficiencies in the pricing of securities issued by the companies undergoing such events. Then they will try to exploit this and basically make money from that. So these corporate events include things like mergers and acquisitions, capital management initiatives, directors' trades, earnings surprises, and corporate distress. I think there's also one more question earlier, just a more of a housekeeping thing, stating that the start time is stated start time is 11 a.m. But our start time is actually 11:15 a.m. for our weekly webinars. Apologies for that because it's due to some technical limitations. We have to put it at 11. We can't choose 11:15. So just to note that it's 11:15 a.m. for our weekly webinars. Thanks. I'll hand it over to the rest of my colleagues. Thank you.
Thanks, Ken. Let me take this one on Disney. So there is there's this question on Disney. As Disney has an improved and increasing number of subscribers, can you share your view on Netflix versus Disney? So Disney actually posted some decent numbers in terms of subscriber growth. But obviously their headline is that they've got 221 million subscribers, which is very similar to Netflix. But the main caveat here is that Disney, when they mention this, they include ESPN Plus, Hulu, as well as Disney Plus. So, for example, if you're in North America and you bundle and you get your Hulu and your Disney Plus, it counts as 2 subscribers. So it's not. Whereas when you compare it to Netflix, it's just a household. So in terms of comparison, it's not really apples to apples. At the same time, when you look at how much ARM or ARPU, which is the revenue per user, you can see that for Disney, the average ARPU is just for Disney Plus, including Hotstar, is about $450. We compare that to Netflix, which is 3 times that. So if you think about it from a revenue perspective, Netflix is earning 3 times more than Disney per user that it has. I think that's one of the main advantages that Netflix has over its competitors, is that it's able to charge more for services. At the same time, when you look at Netflix, they are kind of focusing more on their own original content, so they're relying less and less on licensing from other companies like Disney. And they mentioned in their latest earnings calls that they're actually this content spend is actually stabilizing. So, which is why they guided to free cash flow for this year and exponential free cash flow growth for 2023 as well. So when you look at it moving forward, even though there is always this debate of that Disney is gaining on Netflix, when you dig into the numbers, there's actually a very huge disparity in terms of revenue and earnings. And at the same time, Netflix is still synonymous with streaming. No one really says, "Oh, I'm going to go home and watch Disney Plus and chill," I suppose. So those are my 2 cents on the Netflix versus this comparison. So until we start seeing Disney's ARPU catch up, I think that's when the real comparison can kind of begin, when it's instead of being 63 times less than Netflix. Yeah. So that's all for. I'll hand my time back to you. Thanks.
Okay, let me just try to take some questions. Hi Paul, how come ComfortDelGro is giving higher dividend quarter on quarter per special dividend one time, but the stock price is not moving? Has the 2 dividends been reflected in the current stock price? The interim, okay, so just for everyone's information, they paid 2.8, I'm just recalling from memory, 2.8 cents in interim and they are paying 1.4 cents for special, which the special was related to the disposal gain that they received. The 2.8 is much higher than the 2.1. It's more or less within what we factored in, but even this 2 is still very far from the pre-pandemic. They were paying about from 4. Why it didn't move? The reason why we will share as much as we can, because we didn't, our report was not out yet. But the only negative was that what happened was the China lockdown. So they were hit by a 10 million rental rebate. So that kind of dragged the numbers down. But you should expect, I mean, the numbers speak for itself. When we crunch it, the operating leverage is huge. Firstly, even though the revenue was up year on year by 80 million, 40 million or 40% of it went into the profit. So what we mean by operating leverage is because most of their costs is fixed. So any dollar that goes into revenue, half of it goes to the profit. So that is why we mean by operating leverage. And also, as you can see from the recent SBS data, the rail is really picking up strongly, because the rail traffic is climbing up 50% year on year in July. So at least you get a glimpse of second half. Number 3, the taxi in their call, they did say that the driver takings can be even better than pre-pandemic. So I'm not sure if they will lift. There's still a 15% taxi rebate. That means, and this is all pure profit that they are giving back to the up to September. So there's a chance by October onwards they will lift it up. Then the taxi earnings will come back up. And also, the fourth thing is you haven't really seen the benefit of the booking charge. So they have a 4% charge on booking, which only implemented in May. And so you only see like 1 to 2 months. So even this second quarter, you don't really see the full impact of the reopening yet. I think that could be one reason why the share price is up. But I mean, the whole market is also not doing that well. But I think second half, you will see a really faster growth. Because for us, just to go back to the thesis, this is nothing new, but the operating leverage for this business is really huge. Like I said, every dollar of revenue, half go to profit. So it's going to be a big jump. Of course, their cash is all still very strong and so forth. And their dividends, they used to pay like 10 cents. So they're still far from meeting that dividends. I think our forecast was probably about 7 cents. So there's still upside on dividends. But again, I'm not sure whether, because today maybe the whole market is so big. So that one I'm really not sure how to, but there wasn't anything negative. I just compared to our forecast. Paul, your views on palm oil companies like First Resources, Bumitama. Again, I don't really cover palm oil that well, but I think Malaysia just announced a rule to relax foreign workers into the country. So I think supply might be coming back on. Price-wise, my only worry is that unless you think palm oil price can break a new high, which palm oil price used to trade like 2,000, then went to a high of 6,000. So unless you think palm oil price can bounce clear of 2,000, I'm not sure whether the share price is already peaked. That's my only worry. Again, I'm not a palm oil expert, but that's the worry I have. Unless the palm oil maybe break to 8,000 and so forth, then only the share price can break a new high. Otherwise, the share price might maybe just bounce up and down and be range bound, because they had the biggest bull run, record high, all-time record high in palm oil price. So again, share price wise, I'm not sure whether can it exceed it. Any insight why share price of P&M is down today? So they announced the results that they will only do a briefing on Thursday, so I can't really give much details, but the numbers was a disappointment. We expected the PCR test, because P&M Dental, there are two parts, of course, the dental business and the PCR testing. So that was expected to be weak. So that one we understand. But the biggest one was actually the dental was also particularly weak. So that one I'm not too sure. There's a bit of volatility now, I noticed, in their dental. Last quarter was strong, then fourth quarter was weak, then first quarter was strong, then now it's weak again. So that one we need some clarity on them. So sorry, I can't really give. But that was the main reason. I think the dental, what you do is, again, this is a bit too much details, is that when their PCR COVID comes from minority interests, because they own 51%. So all the profit so that one collapsed. But the problem is that if you take that out from the total profit, was also weak. So the dental, it implies that the dental was also weak, which was surprising. Yeah. I hope that helps you. Comment on ComfortDelGro and UniAsia. Yeah, sorry, UniAsia didn't really go through, but the numbers are really strong because of the Fed rate. So they are having a briefing now, that's why I couldn't go, but we'll have to get the notes from our analyst, then we can give you more details. Yeah. Actually, the briefing is happening now, just that because of this event, I can't go. ComfortDelGro, yeah, already kind of mentioned. Hi, what looks attractive now, US or Singapore market? Probably US, I guess, because the US has dropped so much. And yeah, I think I don't know, this is just my own guess, but for me it would be the US, because considering that they've kind of dropped by so much more than Singapore market. Hi, even though CPI numbers are decreasing a little, however, Fed should still be increasing interest rates in coming months. Do you think that will stall the recent market rally or even cause a reversal in the near term, given that September, October usually are bad months for US market? Okay, I don't think so, because key will be the inflation, because once inflation starts to tail off, then you won't have the tail risk of the Fed raising high rates even more. I think the market is, if you look at the futures market for Fed funds rate, they are still pricing in an interest rate. So I think the market still knows that the Fed will raise. But I think the debate is only in 2024. I think 2024, the Fed funds price is pricing a decline in interest rates. But then that's a bit too far. I mean, all of us don't have such a long horizon. But so the debate is only on 2024 whether the Fed will cut or raise rates. But I think, so what I'm trying to say, just to answer your question, is the market already kind of knows that the Fed will raise rates because it is still very, very loose. I think this is probably the most dovish, the most monetary easing federal officials in the whole of the Fed's life, because the Fed funds rate usually are higher than inflation, the core CPI, which is about 5%. So whatever they may say, they are hawkish, but this is probably on record the most dovish Fed forever since the beginning. Yeah. Okay. September, October usually bad ones. I really can't say. I mean, not really seen any studies. It's a bit. I think when we look at the data, usually whether September, October rally, depends on the prior months. So again, we haven't really seen any any reports on this phenomena. Yeah, it's more. I guess it's more random than anything else. But again, I'm not sure. Maybe you've seen some better data. So I don't think the rally will start. I think it will still rise. I think when we get the PCE inflation data by month end, that will also hopefully show some decline, and then that will probably be another leg. But after a while, this so-called rally over inflation will kind of stall too, because everyone's already priced that in. So it will still be a short-term rally for me. I guess that's what I think. Terence, you want to take the next one?
Yeah, sure, Paul. Take the questions in the queue. Terence, if one only has one choice, should one consider BRC Asia or Pan United in next 6 months? So if only one choice, BRC Asia, because and a few reasons. The first reason is valuations wise, BRC Asia is cheaper, even though both of them are in the same material space. BRC Asia is currently only trading about 5 times for FY22, and they are already 9 months into FY22, so they are about 5 times FY22 and only 4 times of FY23 earnings. So it's very cheap, 5 times earnings. Our second reason is our target price for BRC Asia consequently is also higher. We price BRC Asia at 8 times PE. So that's about 40% upside from current levels, and 8 times PE and 8% dividend yield for FY22. So BRC Asia is a stronger pick. Then the last reason, the third reason is BRC Asia also has a stronger market share. Both are market leaders in their respective fields. But BRC Asia has 2/3 of market share, and PenU is 40%. So all in all, we believe both are beneficiaries of the high upturn in the construction sector, but BRC Asia will likely be a safer bet between the two. Yeah, I think that's all the questions for me. I'll hand back to the rest of my team.
Okay, yeah, thanks, Terence. I'll move on to the next one. Which sector should we position now? Understand that manufacturing is recession. Okay, manufacturing not across the board. I just attended the UMS briefing. So UMS is mainly on semiconductor equipment. So when we hear news on semiconductor big like Micron, these are mainly the memory chips, not the equipment guys. So equipment, semiconductor equipment is still very strong. I think the demand is more than they can cope, more than their capacity for UMS. And secondly, UMS is getting a new customer. I mean, they're not officially announced, but they got a new plant where they got 60% more capacity. So there's a high chance this new customer will come in to fill that. So at least, but demand is still strong because of the number of new wafer fabs. So when the wafer fab is open, you need a lot of equipment. And like we highlighted before, some of this is for strategic reason because US want to compete with China, technology, trade war, then technology war now, and then hopefully nothing else after that. But this tech war also means that there's a lot of new semiconductor wafer fabs, and this will benefit UMS and also benefit AEM. So I think the semiconductor equipment parts is still a sweet spot for the next 1 to 2 years. I think after the 4th year is where you're going to get a big downturn because they probably overbuilt on wafer fabs. But again, that one is 3-year issue to worry. But right now, I think next 1 to 2 years still looks very strong. The other thing is which sectors. For me at least, I still like the Chinese property sector. I guess for me because just the sentiment is just so negative. And like there was a question earlier, the Chinese are lowering rates. Yeah. But not everybody share the sentiment. I think Yan Lot, when our analyst was in the call, mentioned that Yan Lot also very cautious on property sector. Likewise for Yang Zhejiang, the chairman, also very cautious on real estate. But again, we are talking about share price is more the coming. We are positioning more like the 6-12 months view because we think that they can't keep the property market continue to deteriorate. All they have to do is just lift some restrictions, which they've done, and just ease financing, which we think is underway, so that will benefit. Okay, next one. Asian Pay TV, no comment on the recent results, even though they are on Phillip. Yeah, so sometimes we notice that we don't do because we are still in the midst of producing the report. So when we are in the midst of producing the report, we try not to comment too much. Apart from what was the obvious ones, so for them it's more or less meet our expectations. I think that was if you look at our full year, look at year to date, the first half is more or less be in line. There's no new things. The other thing was in the call they also mentioned they gave more details of the 5G. So the numbers there is up maybe 50-60%, but it's still small. I think if you analyze it, they're probably getting like only 2 million revenue. But these are really high margin revenue because there's really no cost to that. So that's the only other highlight for us. But we can only share more details once the report is out. I also apologize for the delay. Just that everyone released the results on the same day, so that's a bit too much for us to handle. Hi Paul, do you think the high dividend of HRnet is sustainable? Yeah. So for us, we don't think he's going to repeat the 3 cents. I mean, they can afford. So just if you want to understand, so for them, they have 1 billion of shares roughly. So 3 cents means they pay 30 million. So very easy to calculate. So they make like 60 million a year roughly, like 60, 70. They can definitely pay 6 cents if they wish to because they have 300 million of cash. Our forecast is they're going to pay 4.5, maybe 5 cents, maybe 50 million. So I don't think they're going to repeat the 3 cents, and again they might probably pay 2 cents and so forth. That's why I think, but they can definitely pay. I think they can pay easily 5 cents if they want, or 6 cents if they want to, because they generate that amount of cash. Because again, this business, why we like it is there's no capex. I think the capex is 200,000 for computers and so forth. Yeah, and they make 660 million or to 70 million. So that's why we like it, because they are very cash generative. Darren, you want to help out on this one? Some of the US REITs, I'm not sure how to.
Yeah, right. So for the US REITs, right, basically right now the current environment is that since the interest rates are rising, which is generally not a good thing for US REITs. However, these three REITs, they are hedged for about more than 80% of their loans. But for Manulife, their first half results, the occupancy dropped, and the outlook for Manulife is not too good because two of their top 10 tenants are not going to renew their leases. So this will really affect them in the future, and they have not secured anyone to replace them. For the US REIT sector, we are more bullish on Prime. It's our top pick among the three. Because right now they're also paying about over 9% dividends, and their assets are better, and they have good occupancy and stable occupancy of around 90% compared to the other two. So yeah, our top pick in this sector is Prime US. Yeah, that's it for me for now.
I can take a couple of questions. So there's this question: which FAANG is more attractive now? So if you include Microsoft, I think as of right now, Microsoft will be the most attractive to us right now, mainly because of their business model, where they're running across. Rather, they've got quite a large. Most of their revenue is from their 365 subscriptions. And they're also, compared to some of the other FAANGs, they're also a little bit more sheltered from weakening consumer demand. So, for example, for example, Netflix, once they've got once they start losing subscribers, and it's red flags. For the other companies that are involved in digital advertising, these are like kind of the easiest budgets to cut in terms of spending for companies. Whereas it's a little bit more difficult to say, I want to stop my 365, my Office subscriptions. At the same time, they are also well positioned in cloud. So their two main revenue drivers are fairly insulated to a lot of outside noise, which is why we think that at least in this environment, Microsoft will be the most attractive. For the second question, hi Jonathan, why is TDCX suffering a beating on its stock price? So I believe they just had they just made an announcement last week, which is why the stock was up 10%. But if you discount that, since their weak guidance during their first quarter earnings, they've just been slowly their stock price has just been slowly coming down. One of the main reasons for this is that, well, first of all, TCX is a service company, so it does a lot of the customer service, a lot of the advertising and sales services for new economy clients, which are your C Limited, your Facebook, and all that. These kind of tech companies. So, firstly, when there's a weak macroeconomic environment like we're in right now, naturally there's going to be a bit of worry on spending, especially on services like TDCX. One of the good thing about TCX is that most of their revenue comes from contracts, so they're all 1, 2, 3 year contracts. The main worry that they were having during that call was getting their current clients to expand their budgets, expand their contracts. I think that has been carried forward over the last couple of months. They are set to report earnings, I believe, at the end of this month. So that should be quite interesting to see what the numbers are. They did revise down their earnings, their revenue guidance for the year, which is quite a negative move. One of the other reasons why TCX is really suffering is that they're not a very high traded counter, so the volume is very low. So naturally, if there's a bit of negative sentiment, it will just keep going down and down if no one, if there's really not much volume to pick it back up. Yeah, I think see if there's any more questions. Yeah, seems like there's nothing. So I'll pass my time on to the rest of my colleagues. Thank you.
Okay, thanks. How would you compare ComfortDelGro, SBS Transit, and Vicom? I'm not, yeah, because there's no real briefing by some of these, but for me, I still prefer ComfortDelGro because of the share, the volumes. I didn't apologize, I didn't really go through in detail Vicom performance, so I missed that. Sorry, I didn't really run through that very closely because I was focusing more on Comfort and there are a lot of moving parts in Comfort because they got a lot of the government subsidy, so you have to strip that out to get the real numbers. So for me, I still prefer Comfort because the volume is there, and I want to get to ride on the taxi. I know it's taxi, right? But I mean, again, we don't think that we're not naive to say that taxi is going to be a structurally strong and so forth, but we think that there can be a big recovery because the share price is still at 40% compared to pre-pandemic, and yeah, and so forth. So that's why we still prefer ComfortDelGro than SBS Transit. We will probably going to get ComfortDelGro to do a webinar with us probably in September. So do look out for them, and then if you've got anything, you can just ask them directly some of these very difficult questions. Any updates on Fortress Mineral and addition? Nothing much. I think just a recap, Fortress Mineral, the volumes will be very strong production because of the new mine. It's just that it all depends on the outlook for iron ore price. So it really is all dependent on that. But the volumes we think for Fortress Mineral can double. And again, sorry to keep repeating, but there's really nothing new because they haven't announced anything. Yeah, so nothing new to add apart from, I guess we can see from the rental business is still very strong. Yeah, from PropNex rental, improvement in rental will actually benefit their co-living business. Yeah. Was there any update from UMS and EEM? Yeah, so UMS, we just mentioned, so we think that is still very positive for UMS. AEM, the briefing is at 3 o'clock, sorry, so I don't have any anything to add for until later, maybe next week. Yeah, sorry for that. Hi Paul, what do you think is causing HRnet share price to remain stagnant despite results in line? Yeah, I think the problem for these stocks is that after they release their results, right, there could be a big gap because they only want to do a results release every 6 months. So between that, without any news flow, right? No, especially in the Singapore market, the volumes might just trickle, the share price might just move sideways. So that is something that we've highlighted to management, that they need to provide more clarity, any business update if they secure contracts. So you notice they've been announcing more contracts. Although to them, this is like run a mill, they always get all these contracts, some of these government contracts to do temp hiring. But I told them that it's very important to at least keep the market informed that operationally things are doing well and so forth. So this is something, not only for them, I mean a lot of companies, Singapore already so small, liquidity already so thin, and you do not want to come up with any news only once every 6 months. And then they always say, well, your liquidity is low, guess why? But anyway, that's something that they one thing good about HRnet, they're mindful of that, and they will try to make an effort to announce things about their business so that investors will know what's the latest going on. Sorry, the very long answer. So in terms of what's causing the news, so I think if you're a trader of HRnet, after you get dividends, you just worry there's like a blackout information. After that, there's nothing happening, no news of anything. No news to trade on it until the results come out. I think that's one of the worries. But again, this is not unique to them. I think a lot of these SGX small cap names think that their volume should be like Facebook's. Yeah, how will real numbers benefit ComfortDelGro? Because they own SBS Transit, so any real increase in ridership will be revenue for them. So for rail, just to remind everyone, so for rail, the revenue goes to them. of course, there's a bit more complication. There's a minimum and maximum profit they can make, but whatever real numbers they collect go straight to them in the P&L. For bus, no. So when you see the bus, when you pay, it doesn't go to them. It goes to the government. Because for bus, it's a contract. So it's a contract. It's a service contract to just drive the bus in circles. Got nobody, so nobody. Too bad, not my problem. No, I mean, not the issue. Sorry. It is basically the government just hire them to drive the bus around. But for rail is different. Rail, they take the passenger risk. The revenue goes directly. So rail is more very important that the ridership climbs, because there will be revenue for them. I'm not sure if you can comment, but any views on China cutting the bank reserve requirement? Is this positive? Or yeah, this is very positive. I'm not sure about the Singapore bank's reserve requirement. So reserve requirement means the amount of money a bank must park in the central bank. I think, correct my number, but I think Singapore is only like 2-3%, if I'm not mistaken. So these are really money that can be used to lend, but it's all trapped in the central bank. But in China, I'm not sure what's the latest. Sorry, I'll probably give you the wrong number, but it used to be as high as 10%. So they're bringing this down, and this will be good because it will give the banks more liquidity to lend. But of course, there's another way to read it, depending you half glass or half full, that this is as a negative signal because the things are slowing down. But again, at least they are still basically they're releasing liquidity, allowing the banks to lend more. Because this money will be trapped in the central bank. Now they can take it and lend it to the banking, into the banking system or into the real economy. HRnet, why would the company want to increase dividend as you suggested? How would it benefit the company and management? Yeah, so for HRnet, the management owns like 78% of this stock. Yeah, so I guess 100 million, they get 80 million. Of course, not 100 million. I mean, 30 million with a share buyback. So I guess they are in the same boat with like all shareholders. What is a better buy now and for the 1 year medium term, AEM, Franken, UMS or venture? My own personal view, although I don't cover UMS, but I think UMS for me stands out a bit more because at least there's visibility with UMS. There's a potential huge customer coming. So that visibility gives me comfort that even though semiconductor might be a bit slower, but like they mentioned, demand is really strong. Like all the semicon equipment makers have mentioned. So for me, I think UMS, because of the visibility of a potential new customer, and the PE is about 10 times. Ventures PE is about 15, 16 times. Yeah, I think that's my own view, like, amongst the three. At least there's greater comfort that there's a upcoming major customer coming from you. Okay. This one on industrial REITs and data centers. Not sure, Darren, if you can help.
Okay, so for industrial REITs, right now we are quite neutral on it. We have a buy call on Ascenders and Capital DC. So the target price we have for, let me see, Ascenders is 3.52 and Capital DC is 2.58. That's our call. So but generally for industrial, the cap rates are still generally quite flat. That is for the data center space. So because there are not a lot of transactions going on also in the data center space right now, so you can't really tell. And for the warehouse, still the warehouses have still been benefiting from higher demand from the logistic players, even though we've seen a slowdown in the e-commerce space because a lot of the e-commerce transactions have been slowing down and more people are going back to retail spend. So yeah, we're quite neutral on the industrial space in general. Yeah. Yeah, that's it for now.
Jonathan, you want to take the tech, China tech or US tech? as we wait for Jonathan, let me just any update on the debt restructuring of their Monte? The debt restructuring has already been done, so they are replacing their 12% high yield bonds with something like I think 5-6%. But because of that, there's a one-off. I think 20-30 million US hit on the P&L for this year. Yeah. The restructuring has already been completed, so you will get the benefit of the growth in earnings per share. But just that you're going to get this one-off. But they really kind of announced the one-off. So for us as analysts, when we do it, we're going to strip out the one-off. When we do our valuations, because so that's the other share price driver, earnings driver for Del Monte. Apart from operations, you're going to get much lower interest expense. Hi, based on history, what usually are the catalysts that can cause mid-cap companies in Singapore to outperform? Yeah, that's the that's interesting. I don't have the best answer, but I guess you need leaders. Yeah, you need one or two share price that really go stratospherically, and then that can elevate the whole market. If there's no one leader in the mid-cap name, then everything will just the interest won't be there. If you got one or two stocks that did really well for good reasons, because of good earnings and so forth, that will normally be the big re-rating for the whole mid-cap companies. In general, just generally speaking. Yeah. But if everything is laggard, then because everyone knows that in mid-cap the risk you take, you're taking some liquidity risk. And also, if I want to play growth in the past, you could get growth in the FAANGs, right? I mean, the US stock, I mean, not now, but at least the US FAANGs were growing 30-40% growth. Why I want to buy a big cap in Singapore for? They can't grow so much, liquidity is so poor. Yeah. But right now it's a bit of a reverse, but just that we don't have one or two winners or leaders, that can help bring up the sector. Del Monte has the share price factoring in the one-off expense. Yeah, I think they telegraphed it already. I think the last two briefings they already mentioned this. Again, this stock is trading 5 times PE, so we still like it. And there's another catalyst that they mentioned that they might want to list the US operations. Again, like beer, like Thai beverage, right? Depending on market conditions. Yeah, but anyway, the parent is trading at 5 times PE. I think anything higher than 5 times will be a good, catalyst for them. Especially, hopefully, I'm not sure if they can even do a dividend in specie, that will be even better. But again, not clear on that. But John, you want to take the China tech versus US tech?
Sure. Yeah, so this question here, given that the Hong Kong market has already been a bear market for almost 2 years, would you recommend investing in China tech or US tech sector if you can only choose one market? Personally, I'd still prefer to invest in the US tech sector. I think investing in China obviously comes with a big country risk. We're not really that privy to a lot of information. If you're based in Hong Kong or China, then it'd be a little bit different because you can you're at least a bit more aware of the policies that are going on there. At the same time, I think they recently just cut their China recently just cut their forecast for the year. So it still looks a little bit sluggish there. Whereas when you look into the US, especially in the tech sector, it seems like the Fed's a little bit more starting to get a little bit more dovish, but we'll see. But definitely, there's a little bit less risk if you compare US to China. And at the same time, a lot of the companies that are listed, like your big FAANG guys, these are global companies that don't just have presence in the US. So it helps in a little bit of diversification in terms of operating geographies. Thanks.
Okay, thanks. Next one, what is a good liquidity level of a stock in your view? Actually, I don't have any magic number, at least a few million, I guess. Again, probably this is just based on, I don't have a really good answer for this. I guess a few million in value that would be in the Singapore context, which is considered good enough for Singapore context. But again, it depends on you, how you want to your own position. There's no hard rule. If you're buying a small amount, then yeah, I don't have a perfect answer for this. Again, it depends on your own how much is the investable funds that you have. If you're a few million, obviously you're going to be very wary, because when you buy, you're the only one buying, selling, you're the only one selling. So again, it depends on your own individual's investment sizing. Please enlighten on commodity prices on Wilmar's profitability. Yeah. Okay. So for profitability, it's not truly commodity, like one-for-one link on commodity price. The reason I say so is that when commodity price go up, like palm oil, yeah, they benefit because they have a plantation, but they will be affected because they got edible oil. So edible oil costs will rise, and then in China, right? So they sell the consumer edible oil, then they get margin squeeze. Their processing also can get impacted by a margin squeeze also, because the processing margin might be impacted because it might shrink. So it's not very clear that high commodity price will then benefit Wilmar, because they are more integrated. They are more driven by consumer stable, so actually low commodity price benefit them. The other unknown is the ability to time the market. Timely purchases. I mean, that's the wording they say, because refining margins might be $10, but the commodity price movement can be a few $100s. So if they get it right, they can earn 10 times more. So the ability to time the purchases is very key, which as an analyst is going to give us a nightmare, because how do we know how well you time? Then the other part of the business, sorry, that's number 2. Then number 3, the other part of the business is the soybean crushing. So that will depend not so much on soybean price, but depend on the hog prices, pork prices or hog prices. So if the demand is the prices go up, then they can pass on the price. They can earn more margin from the meal. That means the feed meal that they sell to these hog farmers. So it's not like commodity price go up, Wilmar will do it. It's a bit of a. It's not that. It's other factors actually. Yeah. Okay, I'm not sure if I confuse everyone on that. Hi Paul, any insight on Credit Bureau Asia? It's been sleeping for quite some time now. So for Credit Bureau Asia, for those who do not know, so whenever you do a credit scoring, that means whenever you apply for a loan and the bank wants to check your credit, whether you have loans, whether you have any loans to other banks, right? Because maybe you might, the best, of course, the trick is to make loan application all at the same time. So all 3 banks, while they're checking you, you look clear. But anyway, so Credit Bureau is very critical. All the banks have it, and it's like a monopoly for them. Or maybe they don't like to call monopoly. They probably like 99% market share. But anyway, I think for them the problem is that they have the valuation is 30 times PE. So the valuations is high, and unless they're branching out to new businesses, but I'm not sure how material that would be. So for me, it's just the very high valuations. Unless they're trying to go into money lending information, and also allowing more people to come into the ecosystem, but not clear how much profitability that can give. Because the main business is the credit part, which the problem is that they own only 51% of that. I'm sorry, they don't own, so that's why I think it's about 51 if I'm not mistaken, but because they have a lot of minority interests. So for this company, you cannot look at the profit after tax. You got to look at the profit after tax after minority interest, because most of the profits go back to the banks. Yeah, because the banks also own a big share of Credit Bureau Asia. So I don't have the precise numbers, but this is roughly. So but right now they're trading like 30 times PE. Is it good to accumulate PropNex stock based on dividend? It is, but maybe not right now. I'm just a bit worried of the any cooling measures coming on. Yeah, because the market is just a bit too hot. That's my worry. And this is a big unknown, right? Nobody can tell you. So I'm just worried that they might slap some TDSR, HDB might slap some more measures, and this might hurt sentiment. Then maybe that would be the best time to buy. But dividend play, yeah, definitely. I think they are also very high net cash company, something like a HRnet. They got it. And the management has really explicitly mentioned many times they want to make this a dividend stock. So they want to keep the yield. Of course, they never telegraph, but I think they want to keep the yield maybe 5-6%. Yeah, to make it like a dividend because they got so much cash anyway, like 100+ million net cash. Yeah. So they can, and the dividend they pay out maybe 20-30 million. Again, I'm just running through my head. I don't have the exact number offhand right now. So definitely a dividend play, but maybe the timing is not now. Okay. Any update on Yoma, Medtech, Innotech? Yeah, so sorry, I don't have updates on this. Yoma, Medtech, Innotech. I think there could be an Innotech briefing. Once that's done, we can brief you a little bit more. But don't have anything major. I think Yoma, they announced a company update, but there was no briefing. So that one is as good as just reading the announcement. Okay, let me just, you want to take this question, Terence, on CDL?
Yeah, sure, Paul, but I may need some help on UOL. But let me just take the question on city developments first. For city developments, the rising interest rates will obviously have a slight impact on their property development business, and that's the reason why they are also a little bit more cautious in acquiring land, new land bank. So they flagged up a little bit more caution. But having said that, they are still aggressively acquiring new land bank. In the first half of 2022, they acquired 4 new sites. So they're cautious for second half, but the outlook for their development properties business remains positive. They launched a few new properties in the first half. For Piccadilly Grand, it was more than 80% sold. And I think in Paul's earlier presentation, he also shared about how Amore Residences was nearly sold out, more than 98% sold. So despite rising interest rates, the underlying demand for property continues to remain robust and strong. The second key driver for city developments is the hospitality segment. In the first half of 2022, the hospitality segment benefited from rising RevPAR and occupancy for all of their properties. So that will remain a tailwind. That tailwind will remain intact for the rest of 2022 and also 2023. Lastly, their fund management business is also growing. They've set a $5 billion target to grow their fund management business, and they're on track to hitting that target. So in the first half of 2022, all of their business units were basically chiming, like humming along, and we believe this will carry through to for the rest of 2022. We don't have any coverage on UOL. I'm not sure if Paul has something to say about that. Over to you, Paul.
Yeah, actually, don't really, haven't really met them. Yeah. Okay, let's go to the last one. Which do you prefer, Apex Realty or PropNex? Which has better financials? I think Apex Realty just announced a 3.5 cents dividend, 3.5 cents interim dividend. So the dividend yield is actually higher at Apex Realty, and you should expect the dividend to remain high because they just have a new shareholder, right, which is a private equity, and the private equity obviously usually we're going to squeeze out every single dollar of cash from them. But in terms of coverage, you will notice we only cover PropNex and not Apex because we always consider PropNex to be the leader, at least market share leader. And we also like it that PropNex balance sheet is cleaner. They don't have property in there. There's pure cash. So that's why our preference has always been PropNex. Yeah. Because when you want to buy any share, we really just want to buy the leader. Unless there's a big divergence in the share price performance between either one. But if not, we typically just buy the leader, and they have a cleaner balance sheet because it's all cash. Okay, with that, thank you everybody.